Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me tonight on tonight's latest episode on how I discovered trading, written for Stratton Markets. And tonight's episode is called How I Came to Understand the Elliott Wave Theory. Written by myself, which is of course James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, before I get on to a brief introduction of myself and obviously tonight's agenda, we are talking about online trading and CFD trading, and with like every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and use your own due diligence and know the risks at hand before entering any trade. Now, with that out of the way, this hairy, wrinkly, sort of looks like I've got slight plump belly in this picture, actually, is myself. Like I said, my name is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. I have over 20 years experience in the financial service industry. I actually started off at the age of 18. I'm now 40. And I started off initially in mortgages, where I specialized in commercial mortgages, both buy to let and for commercial property, before moving into pensions and alternative investments. I got involved in trading around about nearly 14 to 15 years ago. I trade myself, and I've traded for several companies. At the same time, I've ran a trading floor at the Philippine Stock Exchange and traded gold options, which I have a special relationship with, through Dubai Gold and Commodity Exchange. I am indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, City AM, several magazines, and other articles. I am an avid market commentator. I'm extremely passionate about this marketplace. In fact, the matter is, when I was growing up, I had two things I really wanted to be. One was a filmmaker, surprisingly, and the other is obviously a stockbroker. I did that because I watched Wall Street when I was probably a little bit too young, but I got the passion of trading back then. I'm a well-known public speaker, and I've spoken at several industry events around the world: Singapore, Hong Kong, Dubai, Kuwait, Qatar, South Africa, more recently Joburg, Pretoria, Cape Town, London, obviously, because you can tell I'm a Brit, Berlin, and several places. Now, tonight's agenda, obviously, we're talking about the Elliott Wave Theory. So, first of all, we'll discuss what is the Elliott Wave Theory. Then we will discuss the different types of waves of the Elliott Wave Theory. One is the impulse wave. The second is corrective waves. And the rules of the Elliott Wave Theory. We'll then go through some examples and discuss the future education events for March and my usual question and answer session at the end. So any questions, please hold it to the end. Dimitrios, I always see you have a question ready. They don't send me my signals what to do. Dimitrios, talk to me at the end, and we're going to have a chat about that so I can identify what your question is. Okay, so I have not seen it. I've seen it, but let's talk about that at the end so I can understand what you're looking to do. So anyway, let's carry on with tonight's episode. So what is the Elliott Wave Theory? The Elliott Wave Theory was developed as way back as the 1920s. Surprise, hold yourself, brace yourself here. A man called, Ralph Nelson Elliott. They're very imaginative with their names when they come with these theories, like John Bollinger is the Bollinger Bands. Elliott Wave Theory is named after a guy called Ralph Nelson Elliott, so he named it after himself. Very original. Now, the theory is based upon the belief that the stock market is driven by repetitive cycles, not actually by chaos. I put myself on camera here so you can see me. Hello. So the theory is based upon the fact that in his theory, on his belief, the stock market is driven by repetitive cycles. And if you can recognize these cycles, then you can tell where it might go. It's not all chaotic as it seems. And really, Elliot, or Mr. Elliot, I always think when they say Elliot, I think of E.T., Elliot. Elliot believed that these market cycles were created by traders' reaction to the psychology of the masses. So what the masses were doing, what the masses were thinking. Now, he believed, or the theory believes, that these upward or downward movements in the market, he called waves. And he believed if you could recognize these waves, then you could potentially predict where the market may or may not go next. With the idea, of course, that you could spot the opportunity and jump in at the raw wave of the right direction. Now, these so-called waves were actually split into two groups. One is called impulse waves, and the second group is called corrective waves. Now, impulse waves were as follows. Mr. Elliott proposed that the market was in a trend move in 5 to 3 wave pattern. Sounds nice, James, but what actually does that mean? Let me tell you. The first 5 waves were called impulse waves. And the final 3 was called corrective waves. Now, in this pattern, wave 1, wave 3, wave 5 would go where the overall trend the market was going. Wave 2 and wave 4 were corrective. Let me explain this a little bit more. So, this is wave 1, wave 2, wave 3, wave 4, wave 5. Okay, so these are the initial waves. Looks pretty, James. Let's talk a little bit more about it. Wave 1. Wave 1 occurs when the market initially jumps in and pushes an asset upwards or downwards. Let's keep it upwards to keep it simple. Market initially moves upwards. So initial buyers jump in, pushing an asset higher. This is driven initially by a small number of people buying in, as they believe at this point in time that the price of an asset is too low and it's the ideal time to buy. So they're the early adapters. By doing this, of course, causes the price of the asset to rise. So this is wave 1, so the early adapters jumps in, believing the asset is too low in value. Now, wave 2, at this point, the initial buyers, initial adapters, who originally bought in, now consider it is overvalued, and they then decide, you know what, I'm happy with my current profit, secure it, and they start to sell off. And this initially then causes the asset, wave 2, this one here, to fall in value. Waiting in time for the market to then realize that this might be the ideal time to buy in again. Wave 3. This is by far, or should be, if you're following this theory, the longest and strongest wave in the whole process. The asset is now began to court the imagination of the masses. The early adapters were a small number of people, causing wave 1. Wave 2 is where they initially took it and secured their profit. But it hasn't fallen enough, and all of a sudden, the majority of traders, majority of the market starts saying, actually, there might be something to this. This asset might actually be of some greater value than is currently priced. So the masses or greater number of traders start to jump in, and this then causes the price to surge. And this surges should if this theory is correct, or if you're following this theory, be higher than wave one. So wave one, wave two, wave three being the stronger and the biggest of the waves. Wave four, at this stage, majority of the masses then start to lock in their profits, as now they consider the asset is now far too expensive. It's overpriced. And they start to sell off. And this causes the price to drop again. But it's a weak sell-off, as it's not a complete jump ship moment. It's still, there's a few number of buyers in the market, or bulls in the market, believing that, you know, there is still potential between the assets. So we have wave one, wave two, wave three, and then wave four, they sell off. And it's not a gigantic sell-off, it's a small sell-off, which leads to the final wave of the impulse waves. And that is wave five. Wave five is driven at this point by pure hysteria, as the last number of bulls rush into the market based this time not on the opportunity but fear of missing out. This pushes the price higher once again, but this time it drives the asset to a level which is far overpriced. There's no true intrinsic value of the asset at this point. Okay, and the final wave, wave five, then prepares for the big sell-off, which then reverses the overall trend and leads to the next stage, which is the ABC pattern. So wave one, wave two, wave three, wave four, and wave five, the last ditch effort. You can usually tell, I'll just give you a couple of examples of when the wave five is likely to occur. I'm going to give you two examples of this from my experience. Okay, wave five, or the tail end of wave five, when wave five is happening, is when you start seeing the asset being talked about in the press, in the media. Okay, when even non-market related media is covering the asset, is talking about the asset skyrocketing. And there's two examples of this I could think of straight away. One was gold, back at the tail end of 2000, I think it was 2011, when gold had gone on its massive journey of skyrocketing. And it eventually broke the 1900 barrier before having the dramatic reversal, was gold. And that was hitting wave five. And you could tell this because at that time, even the likes of the UK newspapers, totally non-market related, was covering stories of gold. It was in the Sun newspaper, for example. The BBC was talking about it, or not in its non-related business, but on headline media news. It was talking about it. And that's when you knew that this was the wave five. When you started talking about and getting in the national press, you knew that's when hysteria was beginning to set in. So that's one example I can give you from my, what I can remember. The other one, and this is a big one, and you saw this in 2017, and that was Bitcoin. And it's funny, actually, I bring up Bitcoin because I did lots of studies on Bitcoin back in 2007, a lot of educational webinars like this when I was discussing cryptocurrencies. I did a lot of articles as well on cryptos. I'm not a massive fan, if I'm totally open with you, but again, everybody's entitled to their opinion. But Bitcoin, I noticed that technicals, like currencies, wasn't brilliant, but if you look closely at that, you could see the hysteria, you could see the Elliott wave, potentially the Elliott wave theory in it. And when obviously Bitcoin started hitting the newspapers, the Sun, the Daily Mail, whatever you name about it, that's when wave five was coming to its end. And indeed, like I say, obviously the fortunes for Bitcoin reversed itself. So that was interesting. So yeah, you can actually say, like I say, you can see when wave five is occurring, usually when these assets start being talked about in everyday newspapers or everyday media, not the market-related media. But anyway, I'm digressing. So after wave 5, you then get the 3 corrective waves. So wave 1, wave 2, wave 3, wave 4, wave 5, and then you have your corrective waves. First wave, this is when basically hysteria, or the madness of crowds, like I like to call it, has ended. And the market realizes that something is totally overpriced, and people start to jump ship. They jump out of it quite quickly. And this causes initially wave A, which is the initial sell-off. Then you have that small majority of bulls in the market. So we're talking about the uptrend, not a downtrend here. The small majority of bulls who are still in the market, who then go, actually, I still believe that this asset could go higher. And they jump in and they push it up slightly, which is wave B. So small numbers of bulls left. They're causing the asset to jump up just a teeny, weeny bit more. Just a teeny weeny back, not higher than wave A, can't be higher than where wave A started. Otherwise, it's not a corrective wave. Jumps in and it pushes up a little teeny weeny bit. Because they still, you've got the small number of believers still in the market. But there's not enough of them. And by this point, the market realizes, yep, the passion or the hysteria or the madness behind this asset's movement is over. And it pushes that small majority of bulls out of the market. And it causes a bigger sell-off, which is wave C. And this is where the bears really take over and then pushes the asset further downwards, waiting after wave C, where the direction either the market may range or then go on a permanent downtrend again. Now, there are rules behind the Elliott wave theory which you need to follow like gospel. Okay, you need to follow them very strictly, because if you don't follow these rules, then you're not recognizing or not really seeing a proper Elliott wave pattern. And these are the rules. Number 1, wave 3 should never be the shortest impulse wave. It's always got to be the biggest and longest wave. Wave 2, don't forget that's after the initial wave 1. Wave 2 is the smaller sell-off. Wave 2 should never fall beyond the start of wave 1. If it does, we're not seeing the Elliott wave pattern fall. And rule number 3, wave 4 should never go to the same level as wave 1. So if you see wave 4 drop dramatically below the level as wave 1, then again, you're not seeing this pattern at all. So let's look at some examples of the Elliott wave pattern. Okay, so this is Amazon chart. So we're using our naked eye. This is on a daily chart frame, okay? By the way, again, it's, you need to discover this yourself, but I always tend to see or look at it, an asset on more of a longer time frame when I'm looking for a potential Elliott wave patterns, okay? So this is a daily, so let's have a look. So there, wave 1. Initial buyers jump in, thinking the asset is underpriced, pushing it higher. They then go, okay, I'm happy now with my target, lock in their profit and jump out the market. Now, at this point, it's wave 2. So now the masses start to go, hang on, actually, I think there's something to this. And it gets a bigger attention of the masses pushing it up on wave 3. And as you can see, it's wave 1, and wave 3 is a lot bigger. It's a bigger movement. Again, following the rules, wave 3 is always got to be the biggest. They then are happy and they sell off and they start to think, okay, now maybe the drive is overpriced. So they start to jump out, causing wave 4, until the last remaining people who still believe that there is an opportunity, the last remaining believers jump in, causing wave 5, which is the highest, before then we get our corrective waves. Wave A, sell off initially. Wave B, the last few remaining individuals. And then wave C, when the market corrects itself and decides, yes, that roller coaster ride is indeed finished. Selling off dramatically there. This is another example. This is WTI Oil. Again on a daily. Wave 1, initial buyers jump in. Wave 2, initial buyers are happy with their current profit and sell off, causing wave 2. Then, remember the rule, wave 2 can't fall below wave 1. So there we go. Doesn't close or start off with wave 1 started. Causes then the more dramatic move of wave 3, which again has got to be the longest wave, remember. Wave 3. The majority of the bulls have jumped in at this point, believe the asset is overpriced. Jump out, causing wave 4. And before the final, the true believers still believe there's legs on this, pushing up even higher to wave 5. Before then, the market gets exhausted to the corrective wave A. The last few bulls are still there, but not strong enough to break the level of wave A, causing wave B. Slight last breath to push it up higher. Before then, wave C opens, and indeed we then have the corrective wave pushing the asset down further. One more example. This is this is the S&P 500. Let's face it, we all talked about S&P 500. Again, clearly not a real pattern here. This isn't why I took this chart and did this chart today. Wave 1, initial hysteria. This is on a weekly, so it's a longer time frame of the chart. Wave 2, initial people jump in, take their profit, and walk away from it happy. Then you have big wave 3. The masses jump in, hysteria starts to set in, the bulls really take over, causing a very dramatic wave 3. They're happy, take the initial profit before, of course, obviously the sell-off. And then you have the last few remaining bulls in there, causing wave 5. Before then you have the corrective wave A, they sell off, and the last few remaining bulls go, wave B. Because this hasn't finished yet, we don't actually know. Are we actually going to have a wave C? Is it going to start to collapse? We don't. Okay, this is an example of a potential pattern. Is it wave C going to happen, or is it not really, or is it going to move higher? We can't see. But there you go, that's the question. Up and coming educational events. 5th of March, I've got an episode called How I Got to Understand 3 Different Chart Types. 12th of March, I am doing an episode called How I Got to Understand Harmonic, easy for me to say, price patterns. Then on the 19th of March, I've got an episode called How I Got to Understand What Type of Trader I Am. And the 26th of March is How I Got to Know the Importance of Having a Trading Journal. That is a great episode, and I really suggest all those who are starting off or have even been trading for a while, if you haven't got a trader's journal or never used a trader's journal in your life, I really do suggest you attend that episode, because I'll be talking a lot about the importance of trying to use that. Okay, so that's on the 26th of March. And let me try, I truly believe that hopefully will be of some help. Now, before I move into, actually, no, I forgot this. If you if you like to reach out to me, by all means, you can contact me on my email address, which is james@strattonmarkets.com, or you indeed can follow me on my Twitter account, which is @JTriscothic, where obviously I give you heads up on certain things which are coming up in the market and in my sort of style and way of stuff. You can also direct message me on my Twitter account, which is @JTriscothic, obviously. And all that. Now, before we move on to questions, of course, I've been talking about online trading and CFD trading, and like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and note the risks at hand before entering any trade. With that out of the way, any questions? Now, first of all, any questions, of course, related to the subject we've been talking about today, which is the Elliott wave theory. But I had Demetrios had a question from earlier on. They're not sending my signals what to do. Okay, Demetrios, you're talking about your trading signals. You're talking about Trading Central signals. You're not receiving them. Is that right? Is that what it's in reference to? You're not getting your Trading Central signals or something like this? What's that in reference to? Is it's reference to Trading Central or something else? Is it Trading Central, Demetrios, or is that what you're referring to? What sort of signals are you referring to, my friend? Which ones? Okay. Well, I'm waiting for Demetrius to tell me which signals we're talking about. Is there any questions by anybody else in relation to what I discussed tonight about the Elliott wave theory? Anything in particular anybody like to ask me? No? Okay, did everybody at least enjoy it or find it useful and interesting? Or are you just totally bored of me already? Shut up, James, we've had enough of you. God, you talk. God, you go on. Like your new haircut. No? Anybody find it useful anyway? Enjoy it at least. Did you? It helps, yeah? You found it useful, yes, did you? Oh, brilliant. Brilliant. Good. Thank you, Didier. Thank you for the feedback. I appreciate that. Because it does get quite lonely, me just talking to talking away. It's nice to see that there's something. Okay. If there's no questions related to the subject, I have another question for you, great people. Is there any subjects maybe in the future topics you might thanks to you. Oh, thank you, Didier. Is there any sort of topics or content you'd like me to do in the future? Maybe on something else. Maybe you might want me to do a case study. I've done one in the past on gold, but maybe you want me to do a case study on, I don't know, the British pound, US dollar, or maybe even soft commodities. Maybe you want me to do something on corn or sugar, or maybe some of the other metals which aren't talked about, like copper, the red metal. That's a great metal to talk about. Maybe you want me to do some education on that. Or maybe you might want me to do an episode on, I've done it before, but maybe you want me to do like a course on, or an episode on oscillators, support and resistance again, or something like that. Because don't forget, at the end of the day, when I write these episodes, when I do these things and I present them, I am doing it for your benefit, your education, which will help you. Now, I always say this whenever I present, whenever I record this, is that I'm not here to give you the secret answer or the holy grail of trading, because I don't believe there really is one. I think those people out there, the experts who say, "Oh, I made da in this amount of time," if you just follow that, I don't believe. That's rubbish. So what I try and do instead, and what I like to do, is that, because obviously I have a fair bit of experience, is I like to share with you my mistakes as well as my successes, and tell you some of the things which I understood, which helped me, with the idea that it will help you, and you can find your own way, your own system which works for you. okay? Because trading is very individual, and it is dependent on the type of person you are, your personality, and your day-to-day life, and your attitude to certain areas. So I try to cater for this and give you the information so that you can go off and find and think about it and look at it in a different way, and then find your own path. Okay, that is the idea. That's how I do it. So if there's any topics or things you'd like me to cover in the future, you want me to do, please feel free to let me know. Even not tonight. If you suddenly think, hang on, I wish I asked him, or wish I asked James that question, here's my email address. Email me, james@strattonmarkets.com. Or indeed, like I say, follow me on my Twitter. It's my handle, @JamesGothic. Direct message me and do anything like that. Okay. And Demetrios, in reference to your signals, to give me an explanation of what you're looking for and how it may help, please email me and let me know. And I can obviously approach whoever your account manager is, and we can address that question directly for you. Okay. Now, before I sign off, is there any other questions at all? Anything else anybody would like to ask me? Sip my coffee. Okay. In that case, please feel free to review this webinar at the end. Give me 5 stars, give me 3, give me 2. Give me whatever honest opinion you think the quality or what worth it was to you. Like I say, feel free to contact me afterwards if you suddenly have any questions or anything you would like to say, or reach out to me. Wait for the next one. Oh, great, Didier. Looking forward to see you on the next one, mate. I really am. It'd be brilliant. Thank you. And in that case, if that's the case, can I say then simply either a good morning, good afternoon, or a good evening, depending on where you are around the world. Till next time, every single one of you, trade safe.